Every single time the dollar has been under this kind of pressure, gold and silver didn't just rise. They exploded. Welcome to Untold Wealth Theory. And what we're about to walk through is not a prediction. It's a pattern that has repeated across 5 centuries of economic history. And right now, every single condition that has triggered it before is lining up again. Let's start in 1971, because that's the last time the world fundamentally changed how money worked. And most people have no idea what that shift actually cost them. Before August 15th of that year, every dollar in circulation was backed by a fixed quantity of gold. You could, in theory, walk into a bank and exchange your paper money for a physical metal. The system wasn't perfect, but it had a ceiling. Governments couldn't print endlessly. The gold supply didn't expand just because a politician needed to win an election. Then Nixon went on television and ended it. In a 15-minute address, he temporarily suspended the dollar's convertibility into gold. That temporary suspension is now over 50 years old. What happened next was predictable in hindsight. The dollar, freed from its anchor, began to lose purchasing power at a pace the average American had never experienced. Between 1971 and 1980, gold went from $35 an ounce to over $800. That's a 2,200% increase in less than a decade. Silver did something even more dramatic, rising from under $2 an ounce to nearly $50. But here's the part that gets buried in the history books. That wasn't just a price increase, it was a verdict. Markets were telling anyone who was watching that the world had fundamentally mispriced real assets. And whenever that mispricing gets too extreme, the correction is violent. We are in a mispricing right now, and it may be the largest one in modern history. Here's why that matters. The United States currently carries over $34 trillion in national debt. That number is not slowing down, it's accelerating. In the last 3 years alone, the federal government added more debt than in the entire first 200 years of the country's existence. Let that land for a second. And if you find this kind of financial history genuinely fascinating, the hidden mechanics behind wealth, power, and economic collapse, subscribe to Untold Wealth Theory right now. We dig into the stories that textbooks skip, back to the debt. When governments borrow at this scale, they eventually face a choice. They can raise taxes until the economy breaks, they can cut spending until the political pressure breaks them, or they can inflate their way out, essentially printing enough new money that the old debt becomes cheaper to repay in real terms. Historically, they always choose the third option. Always. And when they do, hard assets, physical gold, physical silver, become the last place where value actually holds. Not because they're fashionable, not because of sentiment, because they cannot be printed. Now here's the pattern break you need to understand, the one hiding inside the silver market specifically. Silver is not just a precious metal, it's an industrial metal, and the modern world runs on it in ways that most investors completely overlook. Every electric vehicle uses roughly 1 kilogram of silver. Every solar panel uses about 20 grams. Every semiconductor, every 5G antenna, every advanced medical device, silver is embedded in all of it. Global demand for silver in industrial applications hit a record high in 2023 and is projected to keep climbing for at least the next decade. Meanwhile, silver mining supply has been essentially flat for years. New major silver deposits are rare. The ones being developed take a decade to come online. And here's the brutal math that almost no one in mainstream finance is talking about. The above-ground silver stockpiles that once acted as a buffer have been drawn down dramatically. The world is consuming silver faster than it's producing it. In normal market conditions, that supply-demand imbalance would already have pushed the price significantly higher. But silver has been suppressed by paper markets, futures contracts, ETFs, and derivative instruments that allow traders to take positions in silver without ever touching a single ounce of physical metal. The ratio between paper silver and physical silver is estimated by some analysts to be as high as 250 to 1. For every ounce of real silver in a vault somewhere, there may be 250 ounces of promises floating around in the financial system. That works fine. right up until the moment people start asking for delivery. And in a crisis, they always ask for delivery. Let's talk about what a crisis actually looks like in the precious metals market. Because it doesn't come with a warning label. In 2008, when Lehman Brothers collapsed and the entire financial system froze, gold initially dipped alongside everything else. Panic selling hit every asset, but within weeks the reversal began. By the time the dust settled on the Federal Reserve's emergency response, the bailouts, the money printing, the zero interest rates, gold had entered one of its most powerful bull markets in history, nearly tripling over the next 3 years. 2020 was even faster. The moment the Federal Reserve announced unlimited quantitative easing in March of that year, gold broke out within days. It went from under $1,500 to over $2,000 in less than 5 months. Silver went from $14 to $29 in the same period, a 100% gain in under half a year. Now look at where we are today. Interest rates are at their highest levels in over 2 decades. The commercial real estate market is fracturing. Regional bank balance sheets are under stress. The bond market, the largest financial market in the world, has been in one of its worst bear markets in recorded history. Every single one of those conditions was present before the 2008 and 2020 breakouts. Not some of them, all of them. But let's go even further back, because the most important data is the data that predicts the largest moves. In the 1970s, inflation hit America like a freight train. The cause was a combination of factors: the end of the gold standard, 2 oil shocks, and a Federal Reserve that was too slow to respond. The result was a decade of stagflation, high inflation, high unemployment, and low economic growth happening all at once. During that decade, the stock market went essentially nowhere in real terms. A dollar invested in the Dow Jones in 1970 was worth roughly the same nominal amount in 1980. But adjusted for inflation, investors had lost nearly half their purchasing power. Gold returned over 2,000%. Silver returned over 3,000%. The economists who defended the paper system said it was temporary. They said gold was a relic. They said modern financial instruments had evolved past the need for hard money. They were wrong. And the people who ignored them and bought physical metals in the early 1970s retired wealthy. Here's the uncomfortable question that nobody in mainstream finance wants to ask out loud. What if the 2020s are the 1970s? But worse. The debt load today is not comparable to the 1970s. It's multiples larger. The derivatives exposure in the global financial system in 2024 dwarfs anything that existed 50 years ago. And the Federal Reserve's ability to raise rates to fight inflation is now constrained by the simple fact that the US government itself cannot afford high interest rates on its debt for very long. The government paid over $1 trillion in interest on its debt in 2023 alone. That number is now the largest single line item in the federal budget, bigger than defence, bigger than Medicare, and it keeps growing. When the Fed eventually pivots, when rates come down and the money printer restarts, history says gold and silver will move first and fastest. Now here's what the smart money is already doing, and this is the part of the story that doesn't make the nightly news. Central banks around the world bought more gold in 2022 and 2023 than in any 2-year period since the end of the Bretton Woods system. China has been adding to its official gold reserves every single month for over a year. Russia has systematically moved its reserves away from dollar assets and into gold. India, Poland, Turkey, Singapore. The list of countries accumulating physical gold reads like a who's who of nations that no longer fully trust the dollar-dominated financial order. These are not retail investors making emotional bets. These are institutions with armies of economists, decades of experience, and trillions of dollars at stake. And they are all reaching the same conclusion at the same time. When the largest buyers in the world are moving in one direction, the question isn't whether they're right. The question is whether you'll act before or after the price reflects what they already know. Silver, notably, is not yet seeing that same institutional rush, which means it may have the most explosive upside of any asset in the current cycle. Gold at $2,000 an ounce sounds expensive. Silver at $25 an ounce, given its industrial demand trajectory and paper to physical ratio. Sounds like a gift, if the historical pattern holds. Let's talk about what could go wrong, because any honest analysis has to include the bear case. The bear case for gold and silver is essentially this: inflation gets tamed, the dollar strengthens, real interest rates rise, and the appetite for hard assets fades. That is what happened in the early 1980s when Paul Volcker raised rates to nearly 20% and crushed the inflation of the 1970s. Gold fell from $800 to under $300 over the next 2 decades. Could that happen again? Theoretically, yes, but here's the difference. Volcker could raise rates to 20% because the national debt in 1980 was roughly $900 billion. Today it's $34 trillion. A sustained rate at anywhere near those levels would make the US government's interest payments mathematically impossible to service. The political and economic pressure to keep rates lower than inflation, which is the definition of financial repression, is now essentially structural. The trap has been set. The government has borrowed so much that it cannot afford to truly fight inflation the way Volcker did. And that means the debasement of the dollar is not a risk to be managed. It is a policy that is already in motion. There's a phrase that gets repeated in gold circles: gold doesn't go up, the dollar goes down. That sounds like a bumper sticker until you run the numbers. An ounce of gold in 1913, when the Federal Reserve was created, bought a very fine men's suit. An ounce of gold today still buys a very fine men's suit. The gold didn't change. The dollar lost over 97% of its purchasing power in that same period. What you're doing when you hold gold or silver isn't speculating. You're opting out of a system designed to quietly transfer wealth from savers to debtors, from individuals to institutions, from the careful to the reckless. And right now, every signal in that system is flashing the same warning it flashed before the biggest precious metals moves in modern history. So here's what I want to know from you. Have you already made a move into gold or silver? Are you skeptical, convinced, or somewhere in the middle? Drop it in the comments. Real conversations happen down there, and your perspective matters. If this video shifted how you think about money, even slightly, share it with someone who's still trusting the paper system unconditionally. Not as a favour to this channel, as a favour to them. The dollar didn't collapse overnight in the 1970s. It eroded, quietly, steadily, year after year, until suddenly it wasn't quiet anymore. We may be closer to that moment than most people realise. The question isn't whether the pattern repeats. History has answered that. The question is whether you're positioned before it does come or after.